Hello and welcome to the Friday market update. So the Rearview mirror tells it all. Now, mortgage rates climbed above 7% this week on a 30-year fixed conventional mortgage, according to Mortgage News Daily rate survey. Now, this was a jam-packed week of economic reports, including inflation data and jobs numbers. Now, there are two key drivers of interest rates: jobs and inflation. The Fed has a dual mandate, which is to promote maximum employment, the unemployment rate, and stable prices, which is the inflation. So, how does the Fed manage this? Primarily through adjustments to the Fed funds rate going up or down. The next meeting is November 7th. So, when the Fed raises the Fed funds rate, it is supposed to slow down job growth and spending to help reduce inflation. So, that's what they did originally because it was going so fast during the COVID time. Now, when the Fed funds rate goes down, which they lowered it the last time 50 basis points or 0.5%, it is to spur the economy with new jobs and more spending. It is a delicate balance and based on looking in the rearview mirror to see what happened and what's going on with the economic activity. So the Fed's favorite indicator of inflation, the PCE, Personal Consumption Expenditure, came out this week. And for the most part, the inflation data was pretty tame and in line with expectations. The headline inflation figure dropped to 2.1%, which is almost at the Fed's target of 2%. However, the more important core PCE, which strips out the volatile food and energy prices, remained unchanged at 2.7%. And at least we didn't go the wrong way. So the jobs data this week continues to be the thorn in the side of Wall Street. Last month, the BLS, Bureau of Labor Statistics jobs report, is what started the significant increase in interest rates. Mortgage rates have increased 1% since the low on September 17th, when we were at 6.11%, according to Mortgage News Daily. That's hard to swallow, in my opinion, and not justified. Now, I have spoken repeatedly about the difficulty in relying on the BLS jobs data. So much of this report is guesswork and imputed data. They're just doing revised estimates. They're doing seasonal adjustments. They're trying to give the best estimate they can, but it is really unreliable. So the Fed estimates the numbers and then releases them to the market to provide a foundation for the direction of the economy, and Wall Street trades off these estimates. Then the Fed looks in the rearview mirror, looks at it again to get more actual data as it becomes available and sees if their estimates were correct. But lo and behold, with the exception of last month's job report, it has almost always been revised downward. And so what is Wall Street supposed to believe? They trade off of the current data that came out that day, and they don't look back in the rearview mirror. That's history. That's going on the backside. They are just looking at what's coming in the front, and they're going forward. Now, I'm not an economist or have a degree in statistics, but what I do have is numerous conversations every single day with potential homebuyers. And from my lens, what I hear is that many are just not getting ahead and just trying to keep up. They don't want to get behind, so they're just struggling to try and keep up. Now, there's a lot of talk about wage increases offsetting the increase in inflation, and I'm sure this has helped. However, when people get a raise, they definitely want to actually have a little more money in their pocket to get ahead, a little more to savings. They want to go out for an extra dinner, buy the kids an extra toy for the holidays, get some jewelry for your spouse, whatever it is. They just would like to get ahead, and they're not getting ahead. So it's not just to keep up. Now, one of my clients currently in contract had saved for years to bring their 5-year-old to Disneyland for her birthday. The trip just happened to arrive as they are buying the house. Now, this is a dual income household with great job stability. And I asked her how her trip was when she got back. She was absolutely shocked at how much more expensive everything was on this trip to Disneyland than it was from the past one. The entrance fees, the parking, the dining out, the knickknacks, everything was just more expensive. Now, this is not an anomaly. So my wife is due to have a baby next week. So we have to go back and get the essentials to have a newborn in the house: baby monitors, baby clothes, wipes, breast pumps, crib, bottles, blankets, car seat, stroller, etc. So she came back from her shopping trip just to get the essentials and was amazed at how much more expensive it was than just 4.5 years ago for our son. Now, the compound effect of inflation is at work. It's gone up a lot over the last 4 years, and it just keeps going up based on the increase in the prices at that time. So my opinion is the economy is not as strong as it is promoted to be. Many people are living off of credit cards, and the interest is eating them alive, and it's going to eat them alive even more. So most people right now are paying well over 20% interest on their credit cards because of the high Fed funds rate. Student loan debt is now going to be reported late if you don't start making payments. They gave you a 1-year grace period, and then during COVID, certainly there was a lot of exceptions, but a lot of people have ignored paying student loans because of the COVID and promises that student loans debt would be forgiven. Don't do that. Make your payments, because this will torpedo a credit score for sure. But it's also going to take money out of their pocket on paying for things that other than just fun, right? For clothes, for going out to dinner, that kind of thing. And now they're going to have to start paying on the student loans. So back to the rear view mirror. For those people waiting on the sidelines, waiting to jump into the housing market, but afraid and taking a wait and see stance, if they don't make a jump, they could be the ones looking in the rearview mirror, yelling at themselves for not buying a home because the values are going to go up. Remember, when mortgage rates drop, more people come to the market and home values go up. It's more affordable. Home values went up again this year, despite the higher interest rates for most of the year. It is simply a supply and demand situation where there is plenty of pent-up demand and not a lot of supply. Interestingly enough, the number of transactions that happened this year for real estate was about the same as when I got into this 32 years ago. So the number of transactions has gone way down. But the population has grown tremendously. And there will still be limited supply coming, but those are going to be coming at higher prices due to the new builds, the higher land values, the higher building costs, the higher interest carry costs, the regulatory expenses. So interest rates will drop because it's just going to happen. It's just a matter of when. And the home values will continue to rise. They'll be moderate until the interest rates drop. But once that happens, they will go up. And one more point to consider, pending home sales increased by over 5% month over month from August to September when the interest rates dropped, and we're getting close to that 6%. So the 6% rate appears to be kind of that tipping point that will lead to much greater activity in the real estate market. So as always, feel free to reach out to me directly to get your buyers pre-approved and educated so they can make the right decision for them. You can also send them to my calendar link where I will go through a free CIA analysis, credit, income, assets, those 3 things that you need to get a mortgage. So they know exactly where they stand now and what they need to do to get into a home, get a game plan together. So let's run their numbers. Hope you have a fantastic weekend, and we'll see you next week on the Friday Market Update. This is Gaylord out. Bye-bye.